After 7 straight days in the red, the Philippine stock market finally managed to bounce back. But can this rebound last? Or is it just a short-lived recovery? Let's break down what happened in the markets, the economy, and stocks worth your attention this week. Hi everyone, welcome to Intelligent Investing with me, April Tan. The PSEi ended the week higher by 1.4%, closing at 6,108.86. Gainers outpaced losers 143 to 126. But despite the recovery, foreign investors continued to head for the exits, unloading about 4.3 billion pesos worth of shares. What drove the rebound? First, bargain hunters stepped in as the index hit the key 5,900 support level last Tuesday. Second, the peso recovered, ending the week at 57.87 against the dollar. The dollar index slipped 0.4% on signs of cooling labor demand and the start of the U.S. government shutdown. So the U.S. government shut down because I think the Republicans and the Democrats weren't able to agree on certain items that they wanted to spend on. But, that said, this has been happening for quite a bit. I mean, almost every year this happens, which is why you can see the U.S. market did not even, take notice of it. I mean, they say that they become more cautious, but then, for example, last week, the U.S. market was still up. So that said, Filipino investors shouldn't really be worried. On the economic front, all eyes are on September inflation, with the PSEi releasing the data this Tuesday, October 7. Economists expect a median of 1.9%, up from 1.5% in August, driven by higher food and fuel prices. Still, that's below the BSP's 2 to 4% target, suggesting inflation remains manageable. But growth concerns linger. Both the IMF and ADB trimmed their GDP forecasts for the Philippines, citing global risks, trade tensions, and even climate challenges. Meanwhile, based on the BSP's latest consumer and business confidence survey, sentiment is diverging. If you look at the data, consumers were more optimistic than businesses, especially in the third quarter, citing higher incomes and more family members employed. Businesses turned more cautious, pointing to weaker demand during the Coast Month, weather disruptions, and global uncertainties brought about by higher U.S. tariffs. Improving consumer confidence would mean more resilient consumer spending, although a deteriorating business confidence would mean less investments and hiring. Now let's talk stocks. Oversold names like Converge and URC rebounded, up 2.3% and 3.2% respectively. Interestingly, both URC and MONDE also gained despite a new House bill. This bill proposes higher taxes on sweetened beverages, which are now already taxed, and to also include flavored milk and sweetened coffee products, which were previously exempt. On top of that, there will be an annual indexation of 6% starting 2026. Should the measure pass into law, URC may face the highest exposure, given that its ready-to-drink beverage and coffee mix products account for around 13% of revenues based on COL estimates. MONDE could also be affected through its yogurt drink products, which COL estimates makes up around 7% of top line. To a lesser extent, other listed companies that may also have exposure include AEV, LTG, and FB. However, there is no guarantee that the bill will be passed into law, because a similar proposal to raise excise taxes on sugar-sweetened beverages was filed in 2023 in Congress, but was stalled due to weak legislative support. Nonetheless, the development could create an overhang on select consumer stocks in the near term as investors track the bill's progress. Before the pandemic, the government implemented taxes on sugary drinks, and the thing is, it had a negative impact on the demand for these products. For example, like C2, I remember. Currently, I think they have a 6 peso per liter excise tax. So given how cheap, C2 is, then you slap 6 pesos on top of the price increase was significant. So that had a negative impact on the demand. But I think the difference was in the past, they exempted like the yogurt drinks, the coffee drinks, because those are, I guess, for example, for milk drinks, yogurt, that is considered to be a healthy drink. And then for coffee, Of course, everybody drinks coffee, and it's a mass market type of product, so those products were exempted. Definitely, it is a health move because we know that sugar, is very unhealthy. I think they highlighted more Filipinos are suffering from heart problems, diabetes. So I think part of the proceeds of the taxes that will be raised will be used for the Department of Health, and to treat all these health problems of Filipinos. Moving on to the mining sector, gold miners continue to shine as gold surged 3.4% to a fresh record of $3,887 an ounce. Manila mining jumped 13.2%, OceanaGold gained 12.7%, Apex Mining rose 8%, and Philex added 7.7%. In the water sector, Manila Water rallied 8.8% to 40 pesos per share after Maynilad slashed its IPO's maximum price to 15 pesos from 20 pesos. The lower valuation raised hopes that the long-delayed IPO will finally get done. Maynilad is set to announce its final offer price by October 20, with the offer period scheduled for October 23 to 29. Despite the market struggles, opportunities do exist. With interest rates trending lower, rate-sensitive sectors like REITs and utilities become more attractive, namely RCR, CREIT, and AREIT. Their dividend yields go up as their prices go down, making them even more attractive in a falling interest rate environment. We like RCR because of its sponsor RLC's large diversified rental portfolio. For RCR's portfolio, retail now accounts for 53.2% of the total, improving its resilience. And among the REITs, it has the largest market capitalization, boosting the likelihood of its addition to the PSEi index. For CREIT, we like it because it's more defensive, being a renewable energy REIT. And its sponsor, CREIT, will soon be injecting assets into CREIT, helping it grow. Finally, we like AREIT because its sponsor, Ayala Land, has a large diversified rental portfolio that it can inject into the company. It also has a track record of consistently rising dividend per share. And finally, the company has a growth target of 15 billion pesos to 20 billion pesos in asset injections per year. While the Philippines' economic growth is slowing, it's not expected to contract. This should help corporate earnings and dividend payments stay resilient, which is favorable for long-term investors that are accumulating stocks while sentiment is poor and valuations are depressed. Some stocks that we would be buying on dips include the big banks, BDO and BPI, and power company Meralco. We like BPI because it's one of the most profitable banks in terms of return on equity. The growing share of consumer lending is also helping mitigate the negative impact of lower interest rates on their margins. For BDO, we like it because it's well-positioned to capture growth opportunities given its size as the biggest bank in the country. It is also a beneficiary of its strong ties to the SM Group. Finally, it has a strong and liquid balance sheet with healthy capital ratios. We like Meralco because it's more defensive, being a power company. Meralco also has an attractive growth outlook because of its power generation business, which plans to double capacity in the next 5 years. So, while last week's rebound gave investors some breathing room, the question is, will it hold once inflation data is out this week? A higher-than-expected print could weigh on sentiment and limit further gains. But for long-term investors, weak markets can be a chance to accumulate quality names at attractive valuations. That's it for this week. Once again, I'm April Tan. Don't forget to subscribe so you're first to know what's moving the markets. Stay sharp, stay selective, and as always, invest intelligently.